Hey everyone, welcome back to Corporate Toyota, where we sift through the jargon so you don't have to. Today we're cracking open Hawaiian Electric Industries' latest quarterly report, and trust me, there's more here than just sunshine and good vibes. We'll explore how the Maui wildfires continue to cast a long shadow, impacting everything from their financials to their future strategies, and whether there's enough financial backup to weather the storm. If you appreciate getting straight insights from corporate documents, make sure you're subscribed, and if you want to discuss these things more in depth, then you can join our Discord community, which is linked in the description below. This report covers the first 3 months of 2025, a period ending on March 31, 2025. Right off the bat, this isn't just about profits and losses, it's about navigating a crisis. Let's clarify who we're talking about here. We're dealing with Hawaiian Electric Industries, or EII, which is the parent company, along with its main subsidiary, Hawaiian Electric Company. Think of it as the big boss and its right-hand person. The report itself is a Form 10Q, which is basically a quarterly checkup required by the Securities and Exchange Commission, or SEC. It gives investors a regular snapshot of how the company is doing. Now, let's talk numbers. As of April 30, 2025, Hawaiian Electric Industries had over 172 million shares of common stock outstanding. These shares are publicly traded, meaning anyone can buy or sell them on the stock market. To make sense of it all, the report is broken down into sections covering financial information, management's analysis, risks, and other important details. Let's dive into some key financials. II's net income for common stock was about $26.7 million. At first glance, not too shabby, but hold on, this is where the story gets interesting. Basic earnings per share, or EPS, was $0.15. EPS is a key indicator of profitability, showing how much profit is allocated to each share of stock. But here's the kicker. In the same period last year, their net income was $42.1 million. That's a significant drop, almost 40%. What's behind this dip? A big part of it is that last year's numbers got a boost from discontinued operations, mainly their banking business, which is not part of the picture anymore since they sold the American Savings Bank. Another important number is comprehensive income, which considers other factors beyond net income, like unrealized gains or losses on investments. As comprehensive income was $26.2 million last year, it paints a slightly less rosy picture than net income alone. Now, looking at the balance sheet, their total assets stand at $8.77 billion. This is a slight decrease from December 31, 2024, when they reported $8.23 billion. On the other side, total liabilities are about $7.23 billion. So the difference between what they own and what they owe is their equity. A key detail, HEI is the sole holder of Hawaiian Electric's common stock. Basically, it owns its main subsidiary. Looking at the cash flow statement, we can see how the company is managing its money. Cash equivalents, and restricted cash totaled $1.11 billion. This shows a decrease from the start of the period. Net cash provided by operating activities, which is cash generated from normal business operations, was $49.7 million, a considerable drop from the $124.6 million generated in the same period last year. They use more money on capital expenditures, which are investments in things like equipment, increased in the 3 months, totaling $86.5 million. This suggests they're still spending heavily on maintaining and upgrading their infrastructure. They had net cash used in financing activities to amount to $102.2 million due to principal payments of debt. The biggest cloud over here is without a doubt the legal fallout from the Maui wildfires. They're facing numerous lawsuits alleging responsibility and negligence. To manage this, they've entered into settlement agreements that could cost them nearly $2 billion. That's a massive sum. Under the settlement agreements, Pei and Hawaiian Electric are obligated to contribute a total of $1.9 billion. It's why they had to sell stock. It's a clear sign of how the wildfires have strained their financial resources. The report confirms that neither Hawaiian Electric Industries nor Hawaiian Electric Company are shell companies. This is pretty standard, but it's always good to check off the basics. Beyond the immediate financial figures, the report outlines several risk factors that could affect the company's future. These include things like extreme weather events, the potential for further trade policy changes, and of course the ongoing impact of the Maui windstorm and wildfires, all which increases the risk of the utilities equipment being damaged, becoming inoperable, or contributing to a wildfire. They also highlight their ability to manage environmental, social, and governance priorities, citizen activism, and actions of the US government as other risks that could affect performance. They have to worry about changes in accounting principles, the ability to utilize net operating loss carry forwards, and the final outcome of tax positions. A major point is the implementation of performance-based regulation, or PBR, which could add new incentives but also potential penalties if they don't meet certain goals. It's like a report card that influences the amount of money they make. Also, the continuing ability of key personnel to preform is a growing concern. If you are interested, here are all the exhibits in this report. I summarize what we've found in this 10Q report. On a surface level, we can see the company is profitable, but from analyzing the details in the filing, the company is being negatively affected by the Maui windstorm and wildfires, the loss of a reliable income stream from American Savings Bank due to the recent sale, and more risks due to the credit ratings and state's economic conditions. What are the strengths? The company's performance has been strong. The leadership is strong and the company has a long-established presence in Hawaii. Their commitment to transition to renewable energy will mean good things for the future. Some notable risks include a high level of debt. All economic conditions could influence them to be at risk. So in short, I would hold off on investing into Hawaiian Electric in the short term to see what happens, unless you don't mind some risk. Alright, that's our breakdown of Hawaiian Electric Industries' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord in the description. Thanks for watching. See you next time.